Hey everyone, welcome back to Corporate Decoder, the place where we break down the boring stuff so you don't have to. If you think today's report is going to be a snooze fest, you might want to stick around because we're diving into some serious money management. Today we're dissecting a semi-annual shareholder report from Guggenheim Variable Funds Trust, a look at how their investment funds stack up over 6 months ending June 30th, 2025. And spoiler alert, it involves a lot more than just stocks and bonds. Stick around, because understanding this is key to understanding where your money might be going. This is basically a formal report to shareholders from Guggenheim Variable Funds Trust for the period of January 1st, 2025 to June 30th, 2025. They break down their performance through three main series: Series E, the Total Return Bond Series, Series F, the Floating Rate Strategy Series, and Series P, the High Yield Series. Let's talk about the cost of investing. You see here, for Series E, the Total Return Bond Series, it cost a hypothetical $10,000 investment, $46 for those 6 months, which is 0.90%. This might seem small, but it's important. 90%. This might seem small, but it's important to remember these are ongoing costs. Now, for the exciting part, performance, Series E specifically returned 4.27%, beating its benchmark, the Bloomberg US Aggregate Bond Index, which returned 4.02%. They credit this to carrying income, how they manage their loan duration, and picking the right investments. They also mention that credit positioning hurt them a bit due to trade policy uncertainty. That's a real-world consequence of global events impacting investment strategy. Looking at the long haul, Series E has shown consistent growth from $10,000 to over $12,300 by June 2025. That's competitive when you compare it to the benchmark's increase to $11,222 over the same period. The 10-year average annual return for Series E is 2.81%, which is solid. What did they invest in? Well, Series E is heavily in collateralized mortgage obligations at 37.2% and interest rate swap agreements at 31.8%. Then you've got corporate bonds at 23.9% and asset-backed securities at 16.7%. This diversification is interesting, particularly the high percentage in mortgage-related products. When it comes to the quality of their holdings, AAA and AAA rated investments make up about 45% of their portfolio. While this is good, it's worth noting that 21.9% is labeled as other instruments, which might be worth a closer look for risk. Looking at their top 10 holdings, the Guggenheim Variable Insurance Strategy Fund 3 is a big one at 21%, followed by various uniform MBS and US Treasury bonds. It's good to see a significant chunk in a stable fund like the Variable Insurance Strategy Fund 3, helping to balance out the riskier parts. Moving on to Series F, the Floating Rate Strategy Series, the costs are a bit higher at $58 or 1.15% for that same hypothetical $10,000 investment. It underperformed its main benchmark, the Bloomberg US Aggregate Bond Index, returning just 2.05% compared to 4.02%. They blame this on credit issues in specific sectors and also some equity received from restructurings, which is a complex situation. Over the last 10 years, Series F has seen its $10,000 investment grow to $14,460, which is better than the Bloomberg US Aggregate Bond, but lags behind the S&P UBS Leveraged Loan Index, which grew to over $16,500. Their 10-year average annual return is 3.76%, which is decent, but not market leading. Series F is heavily invested in senior floating rate interests at 89%. This makes sense given its name, but it's good to see some diversification into mutual funds at 4.3% and other at 2.6%. For Series F, the credit quality leans towards BB rated investments at 30% and I% and B rated at 41.9%. This higher concentration in lower rated debt explains some of the performance challenges they're facing. Their largest holding is the Guggenheim Floating Rate Strategies Fund Class R6 at 4.3%, followed by a variety of corporate bonds like Grifols Worldwide Operations USA Inc. and Ascend Learning LLC. This mix shows a strategy focused on floating rate debt, but not without individual company risks. Now for Series P, the high yield series course are at $53 or 1.05% for that $10,000 investment. It returned 4.5 cloning ducks, but underperforming the Bloomberg US Corporate High Yield Index. They attribute their performance to strong credit selection in energy and consumer cycles, but were hurt by bank loan exposures, which is an interesting point about the interconnectedness of different debt markets. Series P shows strong growth over the last 10 years, with its initial $10,000 growing to $15,499, outperforming both its benchmarks. The 10-year average annual return is 4.48%, demonstrating its high yield strategy paying off over the long term. Series P is heavily loaded into corporate bonds at 79.8%, with senior floating rate interest at 11.6%. This focus on corporate debt, especially high yield, is typical for this type of fund. For Series P, the credit quality is heavily weighted towards BB at 45.8% and B at 34.8%. This is expected for a high yield fund, but also signals higher risk. The top holdings reflect the high yield focus, with companies like GrafTech Finance Inc. and CPICG Inc. making up the top 10. This high concentration in individual corporate bonds means that performance can be significantly impacted by the fortunes of these specific companies. These reports often seem dry, but they're packed with clues about how these funds are managed and what risks are involved. Guggenheim's strategy across these series shows a clear focus on leveraging different parts of the debt market. Series E aims for stability with mortgage-backed securities. Series F navigates the floating rate world, facing credit headwinds, and Series P dives into high-yield corporate debt for higher returns but with increased risk. The heavy reliance on level 2 and level 3 inputs for valuation, especially in Series E, indicates complexity and requires constant vigilance from management to ensure fair value is accurately reflected. In the high yield space, the concentration of BB and B rated bonds means investors are taking on more risk for potentially higher rewards. It's a balancing act, and one that investors should be aware of. Overall, Guggenheim's approach seems to be active management across different market segments. They're not afraid of complex instruments like swaps and options, which can add both risk and return. The sheer volume of pages detailing these instruments highlights the complexity of modern fund management. For investors, it means understanding these aren't just simple stock funds, they are sophisticated vehicles with various layers of risk and strategy. One thing that stands out is the consistent mention of expense, waivers and limitations, especially in Series F and P. These waivers, though temporary, show a commitment to keeping costs down for shareholders, a good sign. But as you see with Series F's higher expense ratio, sometimes specialized strategies do come with a higher price tag, and the performance needs to justify it. The company's investment advisory contract renewal process is also detailed, showing a thorough board review based on performance fees and the quality of service. It's reassuring to see this level of scrutiny, particularly for the high yield and floating rate funds, where performance can be more volatile. Looking at the big picture, Guggenheim is playing a complex game. It's a sophisticated operation with a clear strategy, for each series differentiating them to capture specific market opportunities. The risks are explained clearly, but investors need to pay attention to the details, especially the concentration in lower rated debt and the use of complex derivatives. These filings are a window into that world, a crucial tool for investors to understand where their money is invested and the associated risks. So what's the verdict? Guggenheim's funds offer diverse strategies, from stable bond investing to higher risk, high yield approaches. The management teams are clearly actively navigating complex markets using advanced tools. The performance varies by series, with E&P showing stronger long-term trends. While F faces headwinds, the risk profile increases as you move towards high yield and floating rate strategies. The key for investors is to align their own risk tolerance with the specific fund they choose. What's your take on these Guggenheim funds? Do you think the complexity is worth the potential returns? Let me know in the comments below. And if you found this breakdown useful, please give this video a thumbs up and subscribe for more corporate dives. Don't forget to join our Discord community linked in the description for more discussions and insights. Thanks for watching, and I'll see you in the next one.